Hello everyone, welcome to today's lecture video discussing Chapter 2, which is titled Asset Classes and Financial Instruments. So within this chapter, what we will be focusing on is the important features of the different broad classes of securities that we discussed in Chapter 1. So remember, one method or one strategy when constructing your portfolio was the asset allocation strategy, where you focus on different categories of assets, those categories being stocks, bonds, derivatives, real estate, etc. That's what this whole chapter focuses on. So what are the important features of these broad asset classes? So our learning objectives are: first, distinguish among these major assets that trade in money markets and capital markets. Then we will describe the construction of stock market indexes. And lastly, we will understand the basics of options and futures. So a quick refresher in our chapter overview. When building an investment portfolio, think back to Chapter 1. Asset allocation involves making decisions about how much money to allocate to broad classes of assets. So broad classes of assets would be your stocks, bonds, real estate, etc. And then security selection occurs when the investor selects specific assets from within each class. So what we'll be focusing on here today are these broad classes of assets, and then discussing some of the different features for those that would be going into the security selection of specific types of assets. So there are two segments of financial markets. Remember, financial markets are simply where these securities are traded. The first segment is called the money market. Money markets are made up of short-term, marketable, liquid, low-risk debt securities. And these money market securities are often called cash equivalents. They are called cash equivalents due to their ease of conversion to cash. They are very liquid. The ease of conversion to cash being low or high liquidity, short-term, they are considered or oftentimes called cash equivalents. Then we have our capital markets. So capital markets include longer-term and riskier securities, and we break down the capital market into three subsegments. So the three segments being longer-term bond markets, equity markets, and then we have our derivative markets, which can be also broken down into options and futures. So you might see it listed as four segments. Longer-term bond markets, so your longer-term debt obligations, your short-term are included in the money markets category. Equity markets, and then your derivative markets. So just looking at an overview of what we're discussing here, securities are traded here in the financial markets. Financial markets can be broken down into three main types of asset classes: fixed income, equity, and then derivatives. Fixed income has both your short-term fixed income securities, which are called your money market securities. Those are your lowest risk in terms of these types of asset classes. And then your long-term would be the bond market. Then you have your equity market, which is common stocks and preferred stocks. And then you have your derivatives markets, which are options and futures. And it is these three long-term investments that make up the capital market. So once again, money market is simply short-term. Capital market is long-term. So as mentioned, we're going to turn our focus to money market securities. And as was mentioned previously, money markets include short-term, highly liquid, and relatively low-risk debt instruments. Money market instruments include Treasury Bills, certificates of deposits or CDs, commercial papers, federal funds, interbank lending, including the London Interbank Offer Rate, and then some others would be bankers' acceptances, Eurodollars, repurchase agreements, and brokers' calls. Now, some of these you may be familiar with, some of these may be new, and what we will be doing on the upcoming slides is describing these different money market instruments in more detail. Now, typically, these money market instruments trade in very high denominations. So they could be greater than $10,000 per unit or over $100,000 in face value. So oftentimes these money market instruments are out of reach of an individual investor. However, money market mutual funds allow individual access to these money market instruments. So it is important to understand what the details are of these different instruments, because you could invest in them in money market mutual funds. So it's important to understand the different features of these money market instruments. So types of money market instruments. The first one that we will be covering is Treasury Bills. What are Treasury Bills? Treasury Bills are short-term government securities issued at a discount from face value and returning the face value at maturity. So all this means is that there's no intermediate interest being paid to the lender of the funds. So they are lending funds at a discount and they receive a higher amount in the form of face value at maturity. Treasury bills are the most marketable of all money market instruments, and we'll discuss some of the reasons why here when we discuss some of their additional features. One, they are issued by by the federal government. The denomination is $100, but commonly $10,000. So these Treasury bills are more obtainable than some of the other money market instruments that might have much larger denominations. Their maturities are 4, 13, 26, and 52 weeks. So there is a variety of maturities within that 1 year time frame. They're very liquid due to their low risk and high liquidity and ease of conversion to cash. Their default risk is essentially none. We know that nothing is 100% default free, but with these government securities backed by the U.S. government, their default risk is considered none, considered risk free. Their interest type is discount. So as I mentioned previously, you buy it at a discount. There's no intermediate interest, and then you receive the face value, a larger amount at maturity. And what's unique about these Treasury bills is the way that they are taxed. Federal tax is owed, but you are exempt from state and local taxes on these Treasury securities. Now with T-bills, this is how you might see a T-bill quotation if you're looking in the Wall Street Journal, for example. So rather than providing prices of each bill, the financial press will report yields based on these prices. So they are providing, they're reporting, instead of the actual prices, they're reporting the yields based on whatever the price is. So the first one that we're going to direct your attention to is the asked price. So the asked price is the price you would have to pay to buy a T-bill from a securities dealer. And then the bid price is the slightly lower price you would receive if you wanted to sell a bill to a dealer. Now the bid-ask spread is the difference in these prices, which is the dealer's source of profit. So they buy it for the bid price, they sell it for the ask price, and that difference is what is how they make their money. So what we'll do is we'll calculate these different prices based on the listing being reported as yields on the upcoming slide. But before we do so, what is the relationship between bond prices and yields? So if you've taken Finance 3000, or if you understand that yields are used as the discount rate to calculate the price of a future, or yields are used as a discount rate to calculate the present value of future cash flows, as you hopefully understand that there is an inverse relationship. So as yields go up, prices go down. That's why it might seem a little confusing if we're looking at this March 12th of 2015 maturity T-bill. You see that the ask price is 0.04%. That would be the yield at that is used to calculate the price. And then the bid price, even though it's a slightly lower price, has a higher yield because of that inverse yield relationship. As the yield goes up, went up from 0.04% up to 0.045%, the price, or the bid price that the dealer would actually purchase a bond from an investor, or purchase a T-bill from an investor, is slightly lower than what the ask price is. So let's continue on with an example here. So these prices are quoted as an annualized percentage of face value, what is using what is called the bank discount method. So you will need to know what the bank discount method is. So the bank discount method assumes a 360-day year. We'll explain that more coming up. So the first thing that we're going to calculate is the bid price. So if you were wanting to sell your Treasury bill to a dealer, let's calculate what price you would be able to sell it to. What is the dealer willing to pay? So what you would do is you would take, let's say the par value is $10,000. So let's kind of just walk through the different portions of this price calculation. The par value is $10,000. The bid yield is 0.045%. Converted to a decimal would be 0.00045%. And so we would take 1 minus 0.00045% to calculate what the bid price would be. And then we need to annualize that 0.0045 is an annualized rate, and so we need to adjust it for the number of days until maturity, which is 177 days until maturity. So what we do is we take the 177 days until maturity, divide it by the 360-day period, and we get a price of $9,997 and almost 79 cents. So if you were wanting to sell your Treasury bill to the dealer, this is the price that the dealer is willing to pay. Now, if the next calculation here is going to be calculating the asked price. So with this lower yield, you can expect that the ask price is going to be higher than the bid price because they would be willing to buy it at a price lower than what they're willing to sell it at. So once again, we are going to take the $10,000 of par value. We will multiply it by 1 minus the yield, which is going to be 0.04%, but as a decimal, 0.0004. And then we multiply it by the number of days until maturity divided by the 360-day period. And now you can kind of just match up what I said verbally with what's here on the screen. Par value of 10,000. We multiply it by 1 minus the yield to as a decimal, and we multiply it by the number of days remaining until maturity divided by the number of days in the year, and we get the asking price, which is what you'd have to pay if you were going to purchase this bond from the securities dealer. Now notice that the prices and the yields are inversely related. As our yield went from 0.04% up to 0.045%, the price actually went down from $9,998 down to $9,997. And so understand that the higher bid yield, the lower the bid price. So once again, we have this inverse relationship. So the key takeaway is to understand that the bid price and the ask price are what the dealer is willing to buy the security at and what the dealer is willing to sell the security at, and to understand that these treasury bills are not listed as a price. They are listed as a percentage based on whatever the price is. So they are listed as the yield based on whatever that price is. So continuing on with this last column, looking at the asked yield. So the asked yield is what you would actually earn when you purchase it based on whatever this asked price is. Now you can see that it's slightly different here for this March 12, 2015 maturity T-bill. Why is it different? We'll discuss this here on the following bullet points. So let's say an investor buys that bill for the previously mentioned price of $9,998.033, and then they hold it for 177 days until maturity. That investment is going to grow by a multiple of the 10,000 face value divided by what they pay, which is the 1.000197. So the gain is going to end up being that value minus 1, or 0.0197% over the 177 days. To annualize that, we using a 365-day year period, you would take that 177 days and yield and multiply it by 365 over that to annualize it, and what we get is an ask yield of 0.041%. So if you purchased it for the asking price, which is based on this 0.04% yield, you're going to be paying this amount. I guess I didn't have to go all the way down to that part. If you purchase it for the asked yield, which equated to a price of $9,998.033, if you purchase it for that price and you held on to it for 177 days and then received the $10,000 of face value at maturity, your actual yield on that purchase would be 0.041%, slightly different from the way that's listed in this Treasury bill quotation. Now, this is what we just calculate is what is called the asked yield, or the bond equivalent yield, and it's essentially what you would earn when you purchase it at that asked price and hold on to it until maturity. Now, the bank discount method has a long tradition, and despite this tradition, the approach has two major flaws. The first is that it assumes a year has 360 days. When we calculated the asked yield, we adjusted it to 365 days because we know that's how many days are in a year. And we'll discuss here why it assumes a year has 360 days. But then the second flaw is that it computes the yield as a fraction of face value rather than of the price the investor paid to acquire the bill. So we know that your yield would be based on the price you pay. When you calculate the asked yield, or when you calculate the bank discount method, the bank discount yields here, the way that these are listed, they are using it as a fraction of face value rather than that actual price, like in the previous example, the $9,998. When we calculated this asked yield, we used the actual price we paid. When they list these yields using the bank discount method, they do not use the actual price. They compute the yield as a fraction of the face value. So why does the bank discount method actually utilize, or why does it calculate yields in this manner? So basically, this was created before computers. So this way of listing Treasury bills based on their yields was created before computers. So it's much easier to compute percent discounts from a round value, such as the face value, as opposed to the, in our example, $9,998 current price. So it's much easier to compute yields using a face value of $10,000. And it's also much easier to annualize a yield using a multiple of 360, as 360 is an even multiple of many numbers. So this is why the asked yield, when we calculate it using the price that we actually pay and the 365-day period, that is why this asked yield is different than the asked yield price there in this bank discount yield quotation. So moving forward on to our next type of money market security, that was Treasury bills. Our next is certificates of deposits, or CDs. A certificate of deposit is a bank time deposit. It is issued by depository institutions. So a depository institution is simply allowed to accept monetary deposits from consumers. The denominations of CDs are any, but $100,000 or more are more marketable. The maturity of a CD is at least 14 days. Now, going back to that denomination, so these CDs can be negotiable, meaning that they could be sold to another investor if the individual initially that purchased the CD needed funds before the maturity. So that is one thing about the denomination being so large, but they can be negotiable. So as I mentioned going into the next bullet, that the trading of these CDs can be sold to another investor before their maturity dates. Liquidity-wise, the large denominations in 3 months or more are less liquid than their shorter time period CDs. These are covered by the FDIC up to $250,000, so the default risk is protected to an extent. The interest type is a add-on, so if you purchase a CD, you will receive interest and principal at maturity. So you will receive an interest amount and principal at maturity. And with the taxation, these have federal and state and local taxation. So those are CDs. Next up is commercial paper. Commercial paper is short-term unsecured debt issued by large corporations. So if it's unsecured, that means that there is no collateral that is backing commercial paper. These are issued by large creditworthy firms and financial institutions. So these creditworthy firms and financial institutions will use commercial paper instead of borrowing from a bank. So commercial paper was something that was a point of interest during the financial crisis, as these banks, we'll talk about what was going on with the use of commercial paper and why they weren't able to issue it towards the end of the financial crisis or during the financial crisis. But this is something that is used by these institutions instead of borrowing from a bank. The denomination is $100,000. So small investors must invest indirectly in commercial paper in the form of money market mutual funds. Remember that we discussed what a money market mutual fund was at the very beginning of this lecture, when we introduced that a lot of these money market securities are out of the reach of individual investors due to their large denomination. The maturity for commercial paper is usually 1 to 2 months, but it's also up to 270 days. With the liquidity of commercial paper, 3 months or less are fairly liquid. The default risk is that they are unsecured, but they are still fairly safe. So typically, the financial condition of these of these firms and financial institutions can be monitored and predicted over the short time period, the nature of their commercial paper. So they are fairly safe investments. The interest type is discount. So once again, these are issued at a discount of face value and pay out face value at maturity. And once again, these are taxable. So commercial paper continued. Commercial papers are usually used by large corporations to fund short-term obligations such as payroll and inventory. The yield on these commercial papers depend on the time to maturity, so how long until maturity, and the credit rating of the corporation issuing the commercial paper. And as I was getting into kind of starting to get off topic earlier on, when I first introduced commercial paper, in recent years there was a sharp increase in asset-backed commercial papers issued by financial firms, and so the assets that the assets were financed by commercial papers, and these assets often serve as the collateral. So hence the name, the asset-backed commercial papers, and that collateral, the assets, were those subprime mortgages. So when subprime mortgages started to default, large banks found themselves unable to issue new commercial paper due to these defaults in subprime mortgages, which were the assets that were backing that were being these assets that were financed by commercial papers, serving as the collateral. Next is federal funds. Federal funds are funds in the accounts of commercial banks at the Federal Reserve Bank. So depository institutions must maintain deposits with the Fed. This amount depends on the total deposits of the bank's customers. So how many deposits of the customers does this bank have, and then their minimum amount that they must maintain at the Federal Reserve Bank is based on this. Banks trade and then transfer their balances to meet the requirements, usually on an overnight basis. So, for example, let's say one bank has an excess of reserves, whereas another bank has a shortage. So what they'll do is they'll trade and transfer these excess and shortage reserve, or this excess reserve, to meet this federal funds requirement. And the interest rates on these transactions is called the federal funds rate. Now, federal funds have become a source of bank funding. Hence, the federal fund rate is the short-term borrowing rate among financial institutions in the U.S. And what will happen is that the Federal Reserve closely monitors and adjusts this rate through open market operations. So open market operations, you'll learn a lot about this in financial markets institutions. So what this federal funds rate does is that it is a key barometer of monetary policy. Open market operations is one way that the Fed kind of controls this monetary policy. And monetary policy is simply controlling the amount of money in the economy. Now, most investors cannot participate in the federal funds market due to their nature, but the federal funds rate is a key, is something that is key within the economy, is something to monitor, and the Fed does monitor this federal funds rate. Similarly to the federal funds rate, there's another type of interbank lending, and we introduce what is called the London Interbank Offer Rate, otherwise referred to as Libor. So this is the lending rate among banks in the London market. This is quoted in dollar-denominated loans, and it is the premier short-term rate in the European money market. So it is designed to reflect the rate at which banks lend among themselves, and it serves as a reference rate for a wide range of transactions. For example, the borrowing costs of large corporations. So oftentimes you'll see the borrowing cost being Libor plus 1.5 percentage points. So they reference Libor in these borrowing rates. Additionally, if you think back to Chapter 1, the TED spread is the difference between Libor and the T-bill rate, so those short-term government securities. It's an important gauge of credit risk within the banking sector. And there have been scandals or manipulations of the Libor rates, a notable one being in 2012 with a link here provided. And the main reason is that Libor is calculated based on surveys, not actual rates. So what was going on is that these banks were manipulating what the Libor rate was by misstating what they were saying on the surveys as what the rate was between these banks. And so there has been manipulations and plenty of fines associated to manipulating the Libor rate. But regulators have actually proposed phasing out Libor by 2021 in exchange for another means of identifying what is the lending rate being used among banks. And last up, some other money market instruments. First is a banker's acceptance. This is an order to a bank by a customer to pay a sum of money at a future date, typically within 6 months. So basically, this is similar to a post-dated check. So the bank will pay some amount in the future, and these sell at a discount. We also have Eurodollars, which are dollar-denominated deposits at foreign banks or foreign branches of American banks. So this is essentially a way that you can escape the Federal Reserve regulation. Even though they're called Eurodollars, it's not just in European banks. So these are dollar-denominated deposits at foreign banks. It doesn't necessarily have to be in European banks. But this is how you can escape the Federal Reserve regulation. There are also repos or repurchase agreements. These are short-term, often overnight sales of securities with an agreement to repurchase them at a slightly higher price. Typically, the securities involved, since they are overnight or short-term, include T-bills as the underlying security, and then we also have broker's calls. So with broker's calls, investors may buy stocks on margins. That is simply borrowing money to buy securities, and then the brokers in turn may borrow the funds from a bank. So those were a lot of different money market instruments. Hopefully we were able to follow along with the different details and some of the different key features of these different money market short-term securities. What's important to remember is that these money market securities are not risk-free like Treasury bills. So they do offer higher returns than these Treasury bills do. So these other money market instruments do offer higher returns, especially in times during crisis. So if you think back to Chapter 1 and looking at the TED spread, so the difference between Libor rates and Treasury bills, that there was a spike during these financial crises times. And then also looking at the following slide here, the spread between the federal funds rate, so the rate that banks charge one another on meeting reserve requirements, and Treasury rates. You can see that there is a substantial difference between the two rates during these financial crises times. So key takeaways: understand that these are all short-term types of securities. They are money market securities. The only one that is really risk-free would be your Treasury bills, and then the other types of securities actually do have some type of risk and do offer higher returns than what the Treasury bills return typically offer. So that was money market instruments. Now we move on to capital markets. So these are your long-term investments or your long-term securities. First off, we are going to talk about the bond market. So the bond market is composed of longer-term borrowing or debt instruments that the bond market is composed of longer-term borrowing or debt instruments than those that trade in the money market. They include items such as Treasury notes and bonds, corporate bonds, municipal bonds, mortgage securities, federal agency debt, TIPS, so Treasury inflation-protected securities, international bonds. We'll talk about all of these in more detail in the upcoming slides. Sometimes the bond market is said to comprise what is called the fixed income capital market. It is called the fixed income capital market, as most of these different types of securities offer some fixed stream of income or income that is generated by some formula. So the first type of security in the bond market that we'll discuss are Treasury notes and bonds. So Treasury notes and bonds are, again, U.S. government funds. So U.S. government borrows funds in large part by selling T-notes and T-bonds. The different terms simply refer to their maturities. So T-bills were less than 1 year. Treasury notes maturities range up to 10 years. And then Treasury bonds maturities range from 10 years to 30 years. So different different names based on different maturities. These often trade in denominations of $1,000. They make semi-annual interest payments, which are called coupons. There are also inflation-protected Treasury bonds. So in many countries, governments issue bonds that are linked to an index of the cost of living in order to provide their citizens with an effective way to hedge inflation risk. In the United States, we call these bonds TIPS, so Treasury inflation-protected securities. Looking at the way Treasury notes and bonds are quoted here, you can see that we have similar information to Treasury bills, except now with the bid price and the ask price, these are listed as some percentage of face value. So typically the face value is $1,000, and these decimals here towards the end, the decimal portion here, are in increments of 1/128. So this is a minimum tick size. 1 of 1/28, keep that in mind, as a minimum tick size, and some percentage of a point. That's as small as they go in terms of the decimal portion, is 1/128th of a percentage, or that's your minimum price increase. So let's take a look at an example here. Let's take a look at the 2020 February 15 issue. So as you can see, we're not looking at the one that's highlighted there. We are looking at this one here, and going through and calculating some of the different inputs. So how much is the first interest payment? So what we're doing is we're looking at the coupon amount here. That is 3.625% of face value, but it's paid semi-annual. So what we do is we take the $1,000 of assumed face value, and we multiply it by that 0.03625, so 3.625 as a decimal, so that's 3.625% as a decimal, and we divide it by 2 since it's paid semi-annually, and so it's going to be, what is that, 1.8125% of 1,000, which is $18.125. How much would you have to pay if you wanted to buy this security? So if you wanted to buy it, remember the bid-ask spread. The ask is what the dealer is selling. The bid is what they're willing to buy. You can see that this price is higher than the bid price. So the ask price is what you would have to pay if you were wanting to buy this security. So it's selling for 108.9375% of par value. So all you would simply do is take the par value and multiply it by that percentage in decimal form. So 108% is 1.08, and so we multiply that by 1,000 and we get a price of $1,089 and almost 38 cents. And then if you're going to sell it, you would use the bid price, which is 108.8906% of par value. So you multiply 1,000 by that in decimal form. And then to calculate what was the ask price the previous day, what we'll be doing is looking at what the ask price is now, and then what was its change. So it's actually gone up 0.0938% of face value. So we take our 108.9375 and add to it, or subtract the increase of 0.0938, and so the previous ask price was 108.8437% of par value. So it's increased this amount. We would take what it is at currently and subtract the increase to see what it was the previous day. And then what is the yield to maturity? Yield to maturity is based on the asking price, since that's what you're paying, and it is pretty straightforward. It's just 1.880%. So based on this price, with the bond selling at a premium, the going rate out in the market, or the asked yield, is actually lower than what the coupon rate. You can always tell if a bond is going to sell at a premium or at a discount by comparing the coupon rate and the asked yield. Whenever the coupon rate is greater than the yield, the bond sells at a premium, so above face value. In the event that the coupon is less than the yield, the bonds sell at a discount, so they sell it at a value less than face value. Let me ask you a question here as we look at this chart. What is the relationship here between maturity, so time until maturity, and yields? As you can see, the longer until maturity, what happens to the yields? The yields go up. This is due to the effect that these longer maturity bonds have more price risk. So more possibility of fluctuating interest rates out in the market, affecting the present value of the future cash flows, or the price. So those are Treasury notes and bonds, and how they're listed, and how to calculate different bid price, ask price, and yields. Next up, we have what are called federal agency debt and international bonds. So with federal agency debt, you have government agencies that are formed to channel credit to a particular sector that Congress believes might not receive adequate credit through private resources. Oftentimes the housing sector is the one that's most frequently discussed. But you have FHLB, which is your Federal Home Loan Bank. You have FNMA, which is Fannie Mae. You have GNMA, which is Ginnie Mae. You have your FHLMC, which is Freddie Mac. All of these are called government-sponsored enterprises, or GSEs. What is the riskiness behind this federal agency debt? Well, there is an implicit backing by the U.S. government, so these are thought to have relatively low risk. But if you remember, during the financial crisis, Fannie and Freddie were actually taken over in September 2008 due to their investments in these subprime mortgage or into these mortgage-backed securities. So the riskiness is still there, but there is the implicit backing by the U.S. government due to the fact that they are government-sponsored enterprises. In addition to federal agency debt, there are international bonds. So this is for firms that are borrowing abroad, or investors who are investing in foreign companies. And the international capital market is centered in London. You have what is called a Eurobond, is a bond denominated in a currency other than that of the country in which it is issued. So it's called a Eurobond, but it's not necessarily in euros. So it could be a US dollar denominated bond sold in Europe. So it is a bond denominated in dollars other than the country in which it is issued, so it's issued in Europe, but it's denominated in dollars. Or for another example that doesn't actually include euros, it could be called a euro yen, a yen denominated bond sold outside of Japan. So the key with these euro bonds is to understand that really they're just international bonds. And then you have what are called Yankee bonds, and Yankee bonds are dollar-denominated bonds sold in the U.S. by a non-U.S. issuer. Say Japan or Europe has dollar-denominated bonds sold in the U.S., but they are non-U.S. issuers. So those are some international bonds. Continuing on, we also have municipal bonds. So municipal bonds are tax-exempt bonds issued by state and local governments. So they are exempt from federal taxes and oftentimes also exempt from state and local taxes in your issuing states. However, capital gains are taxed. So any increase in the municipal bond is taxed. It's just that your coupon or your interest payments are not taxed. There are two different types of municipal bonds. First, there are general obligation bonds, or simply GOs. These are backed by the general taxing power of the issuer, so backed by that particular local government or state or local government. And then you also this type of debt is rated just like corporate debt. We'll discuss ratings when we talk about corporate bonds, but these are rated based on their default risk. And then the other type of municipal bond is a revenue bond. These are backed by the proceeds from the project or agency they are issued to finance. Think of like the tolls on a new road would be backing a revenue bond, typically issued by airports, hospitals, and these are typically more risky than your general obligation bonds. You also have industrial development bonds, which are revenue bonds issued to finance commercial enterprises. So this is something such as the construction of a factory that can be operated by a private firm. So when issuing these, you get the tax-exempt rate of a municipal bond. And as a result, the federal government actually limits the amount of bonds that may be issued that are these industrial development bonds. And these municipal bonds vary widely in maturity. So looking at municipal bonds, the key takeaways is that they are tax-exempt bonds by state and local governments. The two main types are general obligation and revenue. And let's just take a look at the tax-exempt debt that is outstanding. So 2005 to 2018, you can see that the majority of these, the majority of municipal bonds are those general obligation bonds. So those bonds that are backed by the general taxing power of the issuer. But you can also see that it's roughly $3 trillion worth of municipal bonds, of these general obligation bonds outstanding here in 2018. So it is a substantial type of funding for state and local governments. Now, since munis are exempt from federal taxes, you always have to compare after-tax yields when you're comparing a municipal bonds yield versus a taxable bonds yield. So we always want to compare the after-tax returns on each bond. So let's set up an equation here where we let T equal an investor's combined tax bracket. We let the combined would be state and federal, taking into consideration your combined tax rates. R taxable would be the before-tax return on the taxable bond. We take the taxable bonds return and multiply it by 1 minus T, your tax rate, to equal the after-tax rate. And then we'll just let R sub muni equal the municipal bond rate. So if you want to figure out what the equivalent rates are, we have an equation for the equivalent taxable yield, which is you take the equivalent you take the return or the before-tax yield on the taxable bond, multiply it by 1 minus the tax rate. So essentially what you're doing is getting the after-tax rate and setting it equal to whatever the return is on the muni, since it is tax-free. Or here's another variation of the equivalent taxable yield that you could use. And so if the return or the after-tax yield is on the taxable bond is greater than the return on the muni, then you would take that. Then you would take the taxable bond. Otherwise, the municipal bond would be preferred. So it's not the most complex equation. It just gets a little complex with the variables and the subnotations and so forth. So let's just jump into an example. Let's take a look at, suppose your tax bracket is 25%. Would you prefer a 5% taxable bond or a 4% tax-free muni? Oftentimes, someone might look at this, and if they don't understand the tax implications of a taxable bond versus a muni, you would say, okay, I want a 5% bond, get a 5% yield as opposed to a 4% yield. However, the 4% is the after-tax yield, 5% taxable bond you have to pay taxes on. So let's go ahead and calculate the after-tax yield. So to calculate the after-tax yield, we take the return of the taxable, the before-tax yield, and we multiply it by 1 minus the tax rate. In this case, the before-tax yield is 5%. Our tax rate is 25%, so we're only getting 75% of that 5% return, and so the after-tax yield is actually 0.0375 or 3.75%. So which one would you take? The after-tax yield of 3.75% or the after-tax yield of 4% of the tax-free muni? You would take the municipal security. Now, what would the rate have to be on this taxable bond in order for you to be indifferent between the taxable bond and the tax-free muni? Let's use this previous equation of calculating the equivalent taxable yield, and what we're going to do is solve for the pre-tax yield on the taxable bond. So what we have here is the return of the taxable pre-tax multiplied by 1 minus the tax rate, and we're going to set it equal to the return of the muni, which is the after-tax return. So we are solving for this. We know our tax rate is 25%, and we can see that the return on the muni was 4%. If I divide both sides by 0.75, the return on the taxable pre-tax, in order for us to be indifferent, would have to be 0.0533 or 5.33%. So all we did there was calculate this equivalent taxable yield, and that's what this whole chart up here is showcasing. So they have different tax rates, they have different tax-exempt yields, and then these all signify the yields that the taxable bonds must issue in order to be indifferent between taxable and tax-exempt. So, for example, let's just take a look at the chart so we all understand it. Let's say you're in the 30% tax bracket and you have a 3% muni that's available. All corporate bonds or taxable bonds would have to offer at least 4.29% pre-tax yield in order for you to consider that particular security. Okay, so we always want to consider after-tax yields in comparison when we're talking about taxable bonds versus or tax-exempt bonds like munis. Something to always keep in mind. Now, going into our corporate bonds. These are a means by which private firms borrow money directly from the public. You have different types of corporate bonds. You have secured bonds, which have some type of specific collateral backing in the event of bankruptcy. Then you have unsecured bonds, which have no collateral, and these are called debentures. And you also have subordinated debentures. So these have lower priority on claims and have a lower priority on their claim to assets in the event of bankruptcy. Now, similar to Treasury issued securities, they typically pay their interest semi-annually, and then they return the face value to the bondholder at maturity. However, they do have larger default risk than Treasury issued securities, and we measure the default risk by looking at the rating scores that major rating agencies such as Moody's, Standard & Poor's, and Fitch provide. We'll showcase what these different what the different ratings are. Additionally, though, these corporate bonds may come with options attached. They could be either callable, which means that the issuer can repurchase the bonds at a set price before maturity, or they could be convertible options where the bondholder can convert to equity. There's a lot of different features that come with corporate bonds. All of these different features are discussed in more detail in Chapter 14. If that's something that you have the opportunity to look at, we won't go into it for these purposes. They are discussed in other classes as well, though. But going back to these rating agencies and the different ratings that they provide, here's a look at the different ratings of Moody's and S&P's. You can see what the different ratings are that they provide, and then you can see what type of grade the securities are. Anything triple, for Standard & Poor's we'll look at, anything triple B and above are called investment grade. So these are the ones that have low default risk. Anything below that are called speculative or junk bonds, or sometimes they're called high yield bonds. Why do you think they're called high yield? Well, if they have higher risk, so higher risk, they have higher yields. That risk-return trade-off, keep in mind. If you're going to take on the risk of higher default probabilities, you're going to receive higher returns. Looking at the different yield spreads between your junk bonds, your minimum rated investment grade bonds, and then AAA rated, which is like your Treasury securities. You can see that, just like we stated before, you can see the high risk of junk bonds offering these higher returns than these Treasury bills and also your investment grade bonds. Now, just to put a little context behind the securities that we've discussed, this is the U.S. fixed income market value in billions. So as you can see, Treasury debt is almost $14 trillion. Corporate bonds is $8.5 trillion. But as you can see, that these are very large amounts of fixed income securities that are utilized by these government agencies and also corporations. Moving into another type of security, now we are going into mortgage and asset-backed securities. We kind of discussed some of these in Chapter 1. So mortgage and asset-backed securities are ownership claims in a pool of mortgages or an obligation that is secured by such a pool. So remember the securitization method in Chapter 1, where they are pooling and then trading these securities that are backed by the underlying assets, and trading these securities just like any other security. Different types of mortgages. First would be conforming mortgages. These are less risky. These mortgages, the loans must satisfy certain underwriting guidelines before they may be purchased by Fannie Mae or Freddie Mac. So lower loan-to-value ratios, more disclosure of ability to generate a specific type of income. So these are your loans that are less risky, whereas you have also subprime mortgages, where subprime mortgages are riskier loans made to financially weaker borrowers. Looking at the outstanding mortgage-backed securities that are outstanding, you can see that the conforming mortgages, so those less risky mortgages, make up a much larger portion of the outstanding mortgage-backed securities market. And then you have your private issuers. Those are more of your non-conforming or your subprime mortgages. But what you can see is that there was a spike in those subprime mortgages that were being offered, or that were creating these mortgage-backed securities. And you can see then after the financial crisis that they did take a substantial drop due to the risky nature of the default risk of these subprime mortgages. Additionally, asset-backed securities, so these are the different types of asset-backed securities and their amount that's outstanding. Here at the bottom are the different types of assets that back these securities. So the previous one was mortgage-backed securities. Different types of asset-backed securities include student loans, equipment, credit cards, and automobiles. Once again, you can see a spike in these asset-backed securities during the times right before the financial crisis, and then you can see that there was a decrease in the following years. So that was our second capital market dealing with the bond market. Now we are on to equity securities. First, focusing on common stock. What is common stock? It represents ownership share, or common stock represents ownership shares in a corporation. Each share entitles owner to one vote, and the corporation is controlled by the board of directors, who are elected by the shareholders. So one vote, you get to vote on important matters, and you also get to vote on the board of directors, who help control or who control the corporation. Now, this is considered common stock is what is considered a residual claim. So stockholders are last in line of all who have a claim on the assets and the income of the corporation. So the thought is, if the corporation were to take all of their assets, convert to cash, pay off all of their liabilities, then what remains, the residual value, belongs to their shareholders or common stockholders. Now, with a stock, as a common stockholder, you have limited liability. So the most that you can lose in the event of failure in the corporation is your original investment, so they're not coming after your personal assets. Some key terms when you're talking about stock markets or stock and stock market listings. So seeing these stocks listed in the financial markets. One is what is called the dividend yield. This is the annual dividend payment expressed as a percentage of the stock price. So you take the dividend, the annual amount. Typically dividends are paid quarterly, but you take the annual amount and divide it by the stock price to get some percentage, which is your dividend yield. Capital gains then is the amount by which the sale price of a security exceeds the purchase price. And then lastly, you have your price to earnings ratio, which is a ratio of the stock's price to its earnings per share. So this is what you might see when you are looking at a stock market listing. So you can see all these different stock securities and all of these different pieces of information. What we're going to focus on here is GE. Okay, so we're going to take a look at GE, and I'm not able to put this slide or this chart here on the next slide, but what we'll do is we'll go through each of these different items, so symbol, close, net change, volume, what that all means, and then apply it to the General Electric company or listing here. So you'll be referencing back to this chart on the following slide. Okay, so for referencing back to the following slide, we have the symbol being the ticker symbol GE, just represents that's what we're dealing with. The close is the closing price of the stock. If you're looking back, you can see it's $26.21 per share. The net change is the change from the previous day, so it increased 29 cents per share. So that is listed as a actual amount, not a percentage. You can see that we have a volume there, which is the number of shares traded that day. So over 27 million shares were traded. Pretty self-explanatory, 52-week high, 52-week low, highs and lows over the previous year. The dividend is a summation of the previous 4 quarterly dividends. So you take the summation or the total of those and you multiply it. Or if it's the same per quarter, then they just multiplied it by 4 quarters to get the annual dividend. The yield then is the annual dividend, as we mentioned previously, the annual dividend per dollar paid for the stock. So 88 cents a share per 26.21 share price. You get a 3.36% dividend yield. The PE is the price to earnings ratio. So it's the current stock price divided by last year's earnings. So P1 divided by E0, which is your last year's earnings or the current earnings that you have, not the next year's earnings. And then YTD percent change is the year-to-date percent change. So it's a percentage change in the stock price since the beginning of the year. So let's just go through and answer some questions. Now what we're going to do is we're looking at gas log here. So let's bring up the highlighter here. We are looking at this particular equity security. Let's see if we can apply some of the previous discussed features to answer some questions. So suppose we have $10,000. How many shares of this can I buy at the closing price? The closing price is $24.91. So I have 10,000 shares divided by $24.91 per share. I can buy 401 shares. I have enough to buy 401 and a half or so shares, but in terms of total shares, I could buy 401. Now, how much in dividends do you expect for the next quarter? Well, we can see that the dividends are 48 cents. However, that's 48 cents for the year. So what we need to do is take the dividends are listed as a summation of the previous 4 quarters. So we're going to take 48 cents and divide it by 4, which would be 12 cents per quarter. So 12 cents per quarter here. And it's 12 cents times 401 shares for a total of $48.12 in dividends. Okay? Moving forward, what is GasLog's annual dividend yield? This is listed on an annual basis, so it's just straightforward 1.93%. So the annual dividend of 0.48 divided by the price of $24.91. And then what is GasLog's earnings per share number? Well, earnings per share is equal to, well, it's not explicitly listed here, but what we have is the PE ratio, which is equal to the price divided by the earnings per share. So the price to earnings ratio, they gave us a PE ratio of 40.84, and we take the price of $24.91 and divide by the earnings per share. And so to solve for the earnings per share, they would have had an earnings per share of 0.6099. So they are generating almost 61 cents in net income per share outstanding. That's what earnings per share is showcasing. Okay. Now moving on to preferred stock. So preferred stock has features that are similar to both debt and equity. So like a bond, it promises to pay a fixed amount of income each year, some percentage of par value. It does not convey voting power, just like bonds do not convey voting power. Preferred stock is not like common stock. It does not have voting power in regards to the management of the firm. Firms do have a contractual obligation to pay interest on their debt obligations, but not dividends on these preferred shares. However, these preferred shares are what are called cumulative. Their dividends are cumulative, meaning that If they're not paid one period, they would add up, and then you pay the summation before any payments or any dividends go to common stockholders. And then these preferred stock payments are treated as dividends by the corporations rather than interest. So if you think back to your income statement, they are not tax-deductible expenses for the firm. So their priority, one other thing of preferred stocks, their priority in the event in the event of bankruptcy and their claim on the assets is below bonds, but it's higher than common stock. Now, additionally, when we're talking about equity, we also have American Depository Receipts, or ADRs. These are certificates traded in U.S. markets that represent ownership in shares of a foreign company. So each ADR may correspond to ownership of a fraction of a foreign share, one share, or several shares of the foreign corporation. This is the most common way for investors to own foreign companies. A couple well-known ADRs include Sony Corporation, which is a symbol of SNE, and you also have Honda. So Honda Motor, which has a ticker symbol of HMC, and you also have Toyota Motor Corporation with a symbol of TM. So these are certificates that are traded in the U.S. and they represent ownership in a foreign company, Sony, Honda, and Toyota. Moving forward to stock market indexes. So what are stock market indexes? Stock market indexes represent a collection of stocks, and their performance depends on the constituent stocks. Some examples of what makes up the market or what makes up the index. Some examples include the Dow Jones Industrial Average, the S&P 500, the Russell 2000, which is dealing with small cap stocks. You have Nikkei, which is a foreign, the Tokyo index, and you also have FTSE, which is FTSE, which is another foreign index, but these are just examples of different stock market indexes. Why do these stock market indexes matter? These indexes are the best known measure of the performance of the stock market, and domestic as well as international stock market indexes matter in today's economy. So these indexes can help track the movement of the stock market or a particular sector or an industry. They can help evaluate the performance of money managers, so their performance in comparison to these indexes. And they can also be used as the basis price for derivatives. So, for example, the S&P index futures. Now, investors can very easily buy market indexes for their portfolios. So indexes investments that track or match these different indexes, and you can do this through either index funds or ETFs. So the first type of market index we'll cover is the Dow Jones Industrial Average. Prominent features of the Dow Jones Industrial Average: it consists of 30 large blue chip corporations and has been computed since 1896. It had only 20 stocks until 1928. It is a price-weighted index. The index was calculated as the average price of the stocks in the index, and similar to a portfolio that invests one share in each of the 30 stocks in the index. Why is this called a price-weighted index? Well, it measures the return, excluding any dividends, so just the changes in the values of the underlying securities, on a portfolio that holds one share of each stock. So the amount of money invested in each company in that portfolio is therefore proportional to the company's share price. And what we're going to do is we're going to talk about the price-weighted calculations here on the upcoming slides and how it's actually calculated. So taking a look here first at the different companies that were in the Dow Jones in 1928 versus the current Dow companies 2019, you can see that there is very, very few duplicate names from 1928 to 2019. But continuing on with stock market indexes, there are three popular weighting schemes. The first is price weighted. So for example, the Dow Jones, basically with price weighted, you buy one share of each stock. Higher weights are then given to stocks with higher per share prices. You also have value weighted, which is the S&P 500 and NASDAQ. This is where you have investment that is proportional to a stock's market cap. So higher weights are given to stocks with higher market capitalizations. So they have higher weights as a component of the overall index. And then you have equally weighted or value line composite, which invests the same dollar amount in each stock, so the weights are equal. And so what you're going to see here on the upcoming slides is we're going to do an example where we have two stocks. How are the valuations calculated with price weighted, value weighted, and equally weighted? So first, let's take a look at price weighted. So what we're doing here is we are taking a look at the different weighting schemes and how they affect index returns. So with the price weighted index, let's first consider a scenario where we have stock ABC that has an initial price of $25 and then increases for a final price of $30. And then we have stock XYZ, which has an initial price of $100 and then decreases to 90. What happens to my index under the three weighting schemes? So price weighted, value weighted, and equally weighted. So with price weighted, what you do is you would take the initial date level, so 25 and 100, we add those two together, divided by 2. The initial level of the portfolio is simply 62.5. So that is based on the weighting of the price. You have the $25 security, $100 security divided by 2. The value is 62.5. Our portfolio, stock ABC went up to 30. Stock XYZ went down to 90. So what is our final date level? We would take 30 plus 90 and divide it by 2. Our final date level is 60. To calculate the index return, it would be 60 divided by 62.5 minus 1. So we get a return on the index of minus 4%. If this is kind of confusing, you would just take ending minus beginning divided by beginning. That's how we get the 60 divided by 62.5, and then this is where we get the minus 1. So that's all that this equation right here is showcasing. So our index return actually decreased 4% in this price weighted module. Alternatively, another way that you can compute index return using prices as the weights, take stock ABC. It ended at 30, began at 25, minus 1. It had a 20%. It had a 20% increase with a weight of 25 divided by the initial initial total value of the index, which was 25 for ABC and 100 for XYZ, and you'll get a return on that particular stock of 0.2 or 20%. And then with stock XYZ, they had a negative 10% return, so they went from 100 down to 90. So ending balance of 90 divided by the initial of 100 minus 1, a negative 10% return with a weight of 80%. And then so what you would do is you would multiply return times weight plus return times weight to get this price weighted return. So we have 20% return times 20% weight plus negative 10% return times 80% weight, and we get the index return of negative 4%. And this is a price-weighted return. So it is based on the weighting of the different pricing of the different securities included. Now with value-weighted, you can see we have the same scenario up here. Value-weighted, we actually weight them based on their market cap. So there's higher weights given to the stocks with the higher market caps. So we have stock ABC, which has a market cap of 500. The total market cap of the entire index is 600. So their weight is 0.833. So 83.3% is made up of stock ABC. And then alternatively, we can see here that stock XYZ would be 100 out of that total of 600 for a weight of 16.7. And so the index return using a value-weighted strategy, from our previous example, from the previous slide, stock ABC had a 20% return. It went from 25 up to 30, and its weight was 83.3%. And then stock XYZ went from 100 down to 90, or a negative 10% return, multiplied by its weight. And using a value-weighted strategy, we get a 15% return on the index. Now, alternatively, you could also just look at the total market cap changes, where we have gone from 600 up to 690, so ending balance of 690 minus beginning divided by beginning, or that's the same equation. We just break down the fraction, so you get 690 over 600 minus 1, and that's where you get the return of 15%. Both methods get the same return of a 15%, but that's how you would typically, or that's how you're essentially calculating the return on an index when everything is value weighted. This is the S&P 500. It is a value-weighted index. And then last up would be equally weighted. So each stock has equal weights. So each stock has a weight of 50% in this scenario, since we only have two stocks. So the 20% return of ABC going from 25 to 30, the negative 10% return of stock XYZ, both have a 50% weight. The index return is 5% as a whole. So when you're creating a portfolio to track an index, which method works better? Well, let's talk about the three of them and talk about their the different things that need to be considered when you're creating a portfolio tracking an index. With price weighting, it is determined by the per share price, and the per share price does not have much economic meaning. So the stock market is not the economy. It's important to keep that distinct, that the stock market is not the economy. The stock market is simply where people make bets on what's going to happen in the economy. So remember that these stocks are financial assets, not real assets. Real assets are what determine the productive capacity of the economy. Price weighting is also very sensitive to mechanical changes in per share price, for example, stock splits. With value weighting, that is the most popular in practice, but large companies could be too dominant. For example, Apple in the NASDAQ 100. An alternative is using fundamental value. So fundamental value is simply calculating the present value of the future cash flows. That's an alternative to instead of using the market values for the value weighting index model. The last is equally weighting, and they treat different stocks equally. The implied turnover can be too much, so if it's equally weighted, you're constantly having to rebalance your portfolio for the equal weights, and as a result, it can be difficult and costly to implement. So it doesn't really correspond to the buy and hold strategies. Last up here, our last type of capital market, our derivatives market. An example here, we have a derivative asset is a claim whose value is directly dependent on or is contingent to the value of some underlying asset, and you have both options and you have futures. So types of options include call options, which give the holder the right to purchase an asset for a specified price, called the exercise or the strike price, on or before a specified expiration date. So you have the right but not the obligation. And then so it's like the key phrase with the term option. You have the option to do it, but you don't have to. You don't have to exercise your call option. Same with the put. It gives the holder the right to sell. So a call is to buy, a put is to sell. An asset for a specified exercise price on or before a specified expiration date. And then you also have futures contracts. So futures contracts calls for the delivery of an asset or cash value at a specified delivery or maturity date for an agreed upon price, called the futures price to be paid at contract maturity. So this is a requirement, an obligation if you enter into a futures contract. You must deliver that asset or the cash value on that date when you enter into a futures contract. Two positions for a futures contract. If you hold the long position, you commit to purchasing the asset on the delivery date. If you hold the short position, you are committing to delivering the asset at the contract maturity. So what are the main differences between these two? So again, we're just going into a basic intro into these derivative securities. With options, you have the right, not the obligation to buy or sell, so you don't have to exercise your option. The option is only exercised when it is profitable, and options must be purchased. So you pay a premium. So the premium is the price of the option itself. So when I say that the option is exercised only when it's profitable, the difference between the actual asset price and the option price must also exceed whatever that premium is that you paid to have that option capability. Now with futures contracts, you are obliged to make or take delivery, and so the long or the short position must buy or sell at the futures price, and futures contracts are entered into without cost. So a difference from an options contract that has the premium, futures contracts are entered into without cost. So that wraps up our second chapter here, asset classes and financial instruments. We've talked about a lot of different types of financial assets, breaking them down into first money market securities, your short-term securities, and then moving into capital market securities, so discussing your bond markets, your equity markets, and your derivative markets. I know we've talked about a lot of different features and details, so if you have any questions about anything, don't hesitate to reach out to me, and I look forward to talking to you all soon. Enjoy the rest of your day and week or weekend, depending on when you are listening and watching this presentation. So good luck with everything, and I'll talk to you all soon. Thanks. Bye.